Welcome back, everyone. Today on the Joseph Carlson Show, we're going to be looking at high-quality dividend companies that I am buying today. And I wanted to give you an insight, a look at why I chose these three companies amongst many other good options. So we're going to be looking at them individually, reviewing all three of them, and I'll be explaining why these are the three that I'm buying today. Now in the news, we have the MGM Sphere in Vegas finally being done, and it looks insane. This thing actually looks insane. Vici owns the land on which this thing sits, so we're going to be taking a look at it here. Now, Tesla's up 6% today. It's done incredibly well. And we have a little bit of a goofy interview here. It's a bit of a silly interview because we have two analysts. These two guys, both analysts on Tesla, the same company, that have a wildly different price target. One of them has a price target of around $80 per share. The other one has a price target of around $300 per share. And they're doing analysis on the same company. So we'll be looking at how this happens. How can one company have such incredibly different opinions on that stock? We'll be reviewing both of their arguments and their valuations. And then we also have an update on the media world. We have HBO original shows now streaming on Netflix. This is a little bit of a change in thing. We're going to be talking about the impact of this, what it means, how it impacts Warner Brothers Discovery, how this impacts companies like Disney, and of course, Netflix. Now, before we jump into the three stocks I'm buying today, just a quick mention on something. If you've considered trying out Qualtrim, now is the time to do it. This is the software that you can type in any ticker symbol, which gives you a full 360-degree view of the company. All the valuations, the cash flow. You can look at it on an annual basis or quarterly. It gives you all the metrics readily available for any company, as well as descriptions on why those companies are trading certain directions. It also gives you the employee count, news articles, description of the stocks, insider trading, so on and so forth. Qualtrim even includes a lot of different things like the watch lists. You can save lots of different watch lists, see how stocks are trading, see upcoming earnings dates, and we even have a portfolio section that shows you a ton of information about your portfolio. The reason I mention this is if you're interested in trying this out with a free trial, now is the time. You can access this software with the Patreon membership. It's $10 per month. If you sign up today, your first charge will be the beginning of next month, giving you an entire month to trial it risk-free. So there's literally no risk with trying it out now. And the reason that I don't charge you up front is because I'm convinced that you'll like it. We have people trial it, they want to try it out and see if it's something they like, and they usually end up loving it. That's why the growth of this membership has grown dramatically over time. We're closing in on 4,000 active members right now. Now with that Patreon membership, you don't only get Qualtrim, you also get the Discord with a whole community there, as well as exclusive episodes. I post episodes that are routinely an hour plus long around once a week. So you get a lot of exclusive content as well. So you can try out the Patreon anytime risk-free by using the link in the description below. Now let's go ahead and jump into the three companies I'm buying today. Before we even jump into the companies themselves, to set some context, my basic goal here is to accomplish the same thing that Terry Smith expertly outlines in a very simplistic way. In Fundsmith's annual letters, he always writes about his strategy and he restates the goal of it over and over in simplistic terms. Here we have the strategy outlined on page 8 of his recent letter. He says we continue to apply the simple 3-step investment strategy. And I appreciate when things are simple because I think it's overall a better way to go. He has the strategy as buy good companies, don't overpay, and do nothing. That is basically it. Now, underneath this strategy, there's a lot of research and analysis and studying and effort that goes into this. So this isn't to say that he doesn't put a lot of work into the companies that he's buying, but when you really boil it down and reduce the strategy to what it really is, what I'm trying to do is basically this. Buy good companies, don't overpay, and do nothing. Now, a lot of people wonder, what is the most difficult part of the strategy? They say, is it finding out good companies to buy? Is it not overpaying, or is it doing nothing? All of these are very difficult. Finding good companies to buy is easier said than done. Not overpaying is something that's very difficult, and there's lots of arguments about valuation. We're going to be looking at one of those arguments over Tesla in a minute. But we also have the other difficult part, which is doing nothing. Requires discipline and patience, controlling emotions, not acting irrationally or impulsive. These are all difficult to accomplish. But in my opinion, the one that's the most difficult, that most investors get wrong over and over again, focusing on the other two, is buying good companies. I still believe that this is the most difficult part of investing. And it's a little bit of a contrarian pick here. Most people consider this to be the easiest part. Joseph, buying good companies is easy. It's the part of valuation that's difficult. It's the part of not selling them that's difficult. I've come to disagree with that. I think that buying good companies is the most difficult part. There are literally tens of thousands of stocks out there, all of them with different business models, operational risks, complexities, and determining which of these companies are good or not good is a more difficult task. It's easier said than done. A lot of people buy companies that they consider good companies that I do not consider good companies. And I think this is an area of incredible disagreement amongst investors. So let's go ahead and take a look at company number one that I'm buying. We have a company that's considered a finance company, but I consider it more of a tech company. The company's Mastercard. Mastercard is not just a good company, it's, in my opinion, an elite company, a compounding machine. Now, to describe the qualities of this company and why it separates from so many other seemingly decent companies, I've put together a sheet that shows all the fundamental differences between good companies and not good companies. And again, this is where I think most investors get it wrong. Most investors focus on valuation. Valuation leads them away from good companies in the companies that aren't quite as good. So let's go ahead and take a look at the fundamentals of a compounding machine like Mastercard. The first thing that we look at here is what we want to see in a stock. We want to see strong organic revenue growth, free cash flow growth, and earnings per share growth. Why do we want to see all three of those? That is the trifecta of growth. If a company is growing in revenue, free cash flow, and earnings per share, it can grow any other part of its business. It can do buybacks. It can pay a growing dividend. It can do anything at once. That is the trifecta of growth, and especially if it's organic. What is organic growth compared to inorganic growth? Organic growth is where they didn't have to buy the growth. They don't have to pay an enormous sales team for every single bit of revenue growth. And they don't have to pay for acquisitions. So if a company grows through acquisition, let's say Disney buying Fox Media, that's not organic growth. They had to take out debt. They had to take revenue and buy that growth. So what we're looking for is the trifecta of growth, and preferably as organic as possible. So let's take a look at Mastercard here and see if it matches with this description of growth. We can look at the revenue growth over time. We have it right here, a revenue chart. Overall, over the past 5 years, we have a compounded annual growth rate of 12%. That's a good growth rate for this company. Now, Mastercard does do acquisitions from time to time, but they are small acquisitions. In the business, they call them tuck-in acquisitions, which means that Mastercard will buy very small companies here and there for either a little bit of talent or a little bit of technology to bolster up their already core business. What Mastercard doesn't do is buy enormous separate companies to diversify their business line. So far, they've avoided doing that. So we have the first check here. Mastercard has predominantly organic revenue growth. The other thing that we wanted to look at is the free cash flow of the company. Is it growing in free cash flow? Well, we can see that clearly the free cash flow is growing over time. In fact, it's growing at a faster pace than the revenue. We had revenue growth of 12% for the past 5 years. The free cash flow growth is 14.5%. And then we want to see if they're growing via dilution or if they're doing buybacks. We can do that by switching over to the free cash flow per share. The free cash flow per share shows us that on an adjusted basis of their shares, they're growing even faster. The 5-year free cash flow per share growth was 16.7%. This means that Mastercard is reducing their shares outstanding, making it so that their current free cash flow growth is divided amongst less shares. So you as an owner of this company own more and more of the free cash flow over time. In the past 5 years, growing that almost 17%. And then finally, we have the earnings per share here. So they had revenue growth of 12%, free cash flow per share growth of 17%, and then the earnings per share growth in the past 5 years has averaged 22.8% per year. That is extremely fast. This is like tech startup territory fast. When you look at Mastercard, it doesn't appear like it's going to be a company that does that. How could a company this big with a $300 billion market cap grow its earnings per share and revenue and free cash flow that quickly? They do it. and it's based off of their core business model. So when we look at the first thing that I want, strong organic revenue growth, free cash flow growth, and earnings per share growth, Mastercard has this one as a resounding yes. It has all three. It has an incredible growth profile. The next thing that good companies have, compounding machines have in common, is demonstrated pricing power. They have the ability to raise prices above the rate of inflation without losing customers to competition. Pricing power is raising prices above the rate of inflation while still gaining customer count. See, what Mastercard and Visa really do is they don't offer credit. Mastercard and Visa is not giving you a loan. Mastercard and Visa are actually not really financial companies at all. They're data companies. They're network companies. They move data from one place to another. They connect together a giant, highly fragmented network of millions of issuing banks, millions of customers, and millions of merchants all at the same time. They do it with 100% uptime. If you swipe a Mastercard or a Visa credit card, it will work every single time. There's no downtime with these companies. There's no delay in processing. There's no oops, our server screwed up this time, we're going to have to rate limit transactions. These companies work all the time. What they've accomplished in building out this network is unparalleled. Nothing else comes close. There's a few semi-competitors that look like they're threats from afar, specifically Apple Pay. Apple has a pretty big network, but outside of those networks, there's not much that really comes close to Mastercard and Visa. Now, as Mastercard and Visa connect together all these fragmented parties, as they do the validation and the insurance for every transaction, they collect a fee. The fee is called the interchange fee. The interchange fee is a highly complex fee. There's lots of different rates that interchange charges, depending on if you're using a debit card or a credit card, depending on whether it's online or in person, depending on if it's overseas or in the US. There's all different rates for the interchange fee. But the interchange fee is the fee for using this network and having that insurance. They charge this, and then they also split it between the issuing bank. The issuing bank, like JP Morgan, Wells Fargo, Citibank, actually take a lot of this interchange fee as well. So not all of this goes to Mastercard and Visa. But this entire ecosystem is built on this network. And Mastercard and Visa have ample pricing power within this network. They could feasibly raise prices about as much as they want, but they do so in a self-regulatory way, trying to avoid government scrutiny. So do these companies have the ability to raise prices above the rate of inflation? Yes, they do, and they have. Can they do that without losing customers to competition? Can they raise prices while maintaining and growing their customer base? Well, we can take a look at that question right within Qualtrim. We can look at the amount of revenue this company has, and we can break it down by product category. This shows you how much money they're making on every different segment of their business. We have, in yellow here, cross-border volume fees. That dropped down in 2020. You can see the big fall off there, and it's steadily recovered over time as people are starting to cross borders again and go on vacations. We have domestic assessment fees. This has steadily climbed over time, only dropping briefly for COVID. So we have volume increase in this segment of their business as well. We have other revenues. Now, this is a part of Mastercard most people are not familiar with. They have a lot of other businesses, even outside of credit card processing, like cybersecurity, identification, a lot of things in the tech category. And this does make up a large portion of their revenue. This is subscription-based, license-based revenue that's growing over a long period of time at a quick rate. So we see growth there as well. Then we have transaction processing, the biggest portion of their revenue. This is also growing steadily and at a minor dip during COVID. Every segment of their business, every single part of it, is growing rapidly over the past couple of years with price increases. Now, are these companies scalable? Scalable is what you want in a tech company. You want to be able to make a product and sell it to 2 customers, and then 3 customers, and then 4 customers without incurring additional expense. This is harder to accomplish than it seems. It seems like you could spin up any type of tech company and accomplish this, but what we've seen is that big companies like Meta and Microsoft and Google have incremental expenses as they sell to more customers. So when we can find a truly scalable company, that's something special. An easy way to determine if a company's truly scalable is by simply looking at the profit margins mapped out over time. We can look at the profit margins of Mastercard. Since 2009, it was around 30%, which is very high. This is already an absurdly high profit margin. 30% is insane. But what has Mastercard done over time? It increased that profit margin in the next 5 years to 37%. So it went from 30 to 37. How did it do that? Well, it did it by scale. Then what have they done over the next 5 years? It's gone from 37% to 45%. Another leap forward in profit margins. So does Mastercard have scale? Yes, the company has scale. Is this company a great steward over cash flow? Do they have tight control over their costs? Now, this is a question that's a little bit more difficult to answer because when you look at the financials of a company, you don't see all the nonsense that's going on in the company that's being hidden by the profitability of it. Mastercard is such an incredible company. They generate so much cash that the management could become pretty loose with the cash flow. They could start spending it very selfishly. They could start spending it on silly things. We've seen a lot of companies do this recently. We have a report that Salesforce, for example, is paying Matthew McConaughey, the actor, a reported $10 million a year for creative help despite laying off 8,000 employees. This is a bit of a red flag. Do they really need to be paying him $10 million per year? That seems a bit excessive. And what does this say about the rest of the company? If this is happening, what other type of expenses are happening? We've seen other things like this that highlight the type of spending that many tech companies do. Google cutting 1,800 employees, including 27 massage therapists. Nothing against massage therapists, they're great. But a company that's hiring dozens and dozens of massage therapists shows where their spending habits are at. When I look at Mastercard, I can't find any evidence of this type of spending. In fact, when I look at all the metrics, I also don't see excessive stock-based comp or rewards going to employees. Most of the money, in fact, almost all of the profits this company makes, beyond the salaries it pays its employees, are returned back to the shareholder. And as shareholders, that's something that we need to pay attention to. Mastercard and Visa both have exercised tight control over cash flows, returning the huge majority back to the owners of the company. Now we're getting down to the last ones here. We have the predictability of cash flows and earnings. This is one that I probably should put higher on the list, but all of these are really important. Predictability has moved up to be one of the top things I look for. If a company is widely unpredictable in its future, I don't think you're investing, I think you're gambling. If there's variables that you can't possibly see how they're going to turn out, I don't think you're investing, I think you're gambling. Predictability is key within this strategy. When we look at the predictability of the future, we can use the past to inform us on that. We see consistent revenue growth despite government intervention and regulations, despite many competitors. We see consistent free cash flow growth, we see consistent earnings growth, we see consistent dividend payments. So far, there's nothing with either Visa or Mastercard that makes me feel these companies are unpredictable. And then finally, I'm preferably looking for companies that are also service-based monopolies. This is something that Warren Buffett hasn't specifically outlined. He hasn't said, I look for service-based monopolies, but when you go through the list of purchases he's made, so many of them fit right in that category. So many of them are service-based monopolies. Throughout his entire investing history, this has made up an enormous part of his portfolio. Buffett uses the more friendly term moat. You have a castle and you want to protect it from invaders. What I use is a term that I think is more honest. I'm looking for companies that are monopolistic by nature. Preferably, they're good monopolies. Monopolies that benefit the consumer and the government. Monopolies that actually add value to the customer. In the case of Mastercard and Visa, I do believe that they're monopolistic. I believe they share what's called a duopoly, a shared monopoly between two huge entities. So we have there a service-based monopoly. Now, when I've gone through and I've screened a company like this through all the filters that I want, all these things that I'm looking for, that's when I start to determine whether or not this is a good company. So if we go back to this simple outline here, buy good companies, don't overpay, and do nothing, all of a sudden buy good companies takes on a different meaning. When we look at the decisions investors make, most of them are buying all sorts of different companies, ones that I consider to be very poor companies, very risky companies, and then most of the focus isn't on the company that they're buying, it's on not overpaying. It's on the price that they're buying the company at. This gets the majority of investors' time and attention when more time should be spent on what company they're actually buying. What I try to do is buy these type of companies, the highest quality ones, at reasonable or low valuations. That's what I'm aiming for there. What I want to avoid is buying into these companies at egregiously high valuations, where even the most bright future of the company is already priced into the stock. Let's take a look at Mastercard as a for instance here. The free cash flow yield of the company is 2.71%. Stock-based comp makes almost no difference. In my opinion, I don't think that's an egregiously high valuation, for a company that grows as fast and as consistent as Mastercard, especially if the trend of digital money taking over physical money continues in the future. So Mastercard trades at a decent starting yield today and has ample room for growth in the future. And then when I look at my watch list and I look at how Mastercard has traded compared to other companies in my portfolio, I can see which ones are really having a lot of enthusiasm and a lot of momentum in their stock price. This is the last 3 years of trading for each of the companies that I own currently. We have off to the right all the companies that are really doing well right now. Texas Roadhouse, Apple, Costco, and Microsoft. These ones have rocketed up over the past 3 years. Then we have Mastercard over here. This one is one of the lower ones. It's only gone up 25% over the past 3 years. It's really in a slump right now. So we have an incredibly high quality company that's been in a bit of a slump for the past 3 years. So in terms of relative valuation and momentum, and in terms of absolute valuation, I believe Mastercard's a reasonable buy today, valuing it either way. Now, the other two companies that I'm also buying today are in the industrials. It's the two railroads. I'm adding to both of these positions. Even though these companies are seemingly way different than Mastercard, they operate in a completely different industry, they have many of the same characteristics. Like Mastercard, they share in a duopoly or an oligopoly. They're monopolistic. They're difficult to really compete with. They have incredibly high barriers to entry. We're not going to see any more Class 1 railroads. And they're trading at valuations that are not that high of hurdles. A 3.5% starting yield is a decent starting yield today. When I buy Canadian Pacific and Union Pacific, I'm not expecting 10x returns next month. These aren't those type of stocks. But I believe on the low end of returns these companies will provide is somewhere around the S&P 500, matching the index. And I believe they have a high likelihood of beating out the S&P 500 between their total returns of dividends paid and capital appreciation. So those are my 3 buys today: Mastercard, Union Pacific, and Canadian Pacific. Let me know what you think and if you enjoy this type of analysis, and I'll do more of these videos in the future. Now let's go ahead and move on to some news. Now the first thing is we have this look at this video here that surfaced online, taken from someone's cell phone, and it's gotten a lot of interest, and this thing looks crazy. They say the Sphere's interior will be equipped with 16K resolution wraparound LED screens measuring 160,000 feet. It'll be the largest high-resolution LED screen in the world. The exterior of the venue will feature 580,000 square feet of programmable lighting. The Sphere will feature 164,000 speakers. There's going to be 4D features, including scented and wind, and the seats themselves will have haptic feedback. This is going to be one crazy venue in Vegas. Now, of course, Vici themselves does not own this, but they do own the land in which this sits on. Now, moving on, we have a massive price jump in Tesla today. The stock today is up over 7% as their car delivery numbers exceeded expectations. And in this interview here, we have 2 analysts who have varying views on Tesla, and this gives you an idea of how difficult it is to nail down the valuation of some companies, especially ones like Tesla.
I just don't see how you can have price targets like this. It just, I guess it's a commentary on the stock and how people feel about Tesla and Elon Musk. I thought I checked the numbers to see if they were right. Ray, you have a buy on Tesla with a $320 price target. Craig, you have an $85 price target.
So the guy on the bottom there, he has a price target of $320 for Tesla. The guy on the top there has a price target of $80. Now, currently, as the stock stands today, the guy on the top will be laughed at because his price target is further away from the current price. Tesla trades at $280, so how could you have a price target of $80? The guy that has a price target of $320, he seems like he's more reasonable right now. Right? That's what most investors probably think with this reaction. But one thing to keep in mind is the volatility of this stock. Just 6 months ago, Tesla was trading at a price of $110. So in 6 months, it's gone from making the guy having a price target of $80 look like a fool, and the guy having a price target of $320 look like he's correct. But here they are to defend their different analysis on the stock.
You're looking at the same thing. Craig, you had a hold too. When did you put that 85 on there? Did you? It was in 2000. When did you put it on?
It's been on for like a year and a half, 2 years right now. I don't remember exactly when I put it on.
Your privates are in a vice, man. Craig, aren't they? I mean, aren't you howling in pain? Huh?
Heck no, man. Heck no, right? The point today is price cuts work. right? There's demand for EVs out there. EVs are something compelling to a tranche of consumers. EVs are inevitable, right? That is the punchline today. But when you step back and you say this 6% move is a $50 billion increase to the market cap, and you look at the market cap of Ford today at just $60 billion, that puts it very clearly in context. Tesla has more than 100 other competing EV models coming to market to compete against their four mainline units. You know, many of those are going to be wildly successful. The same pressure we saw in the back end of last year that brought this thing basically down to 100 is going to build into the end of this year when those models actually launch, and it's going to intensify next year. So the valuation, it's absurd. It's egregiously overvalued, but I get it. It's a consensus long. It's a company that's executing. That's why I don't have a sell rating. I have a neutral rating because I got a lot of levers to throw.
Now that's a little bit confusing on his part. He says the price target's $80, but he doesn't have a sell rating because he says it's a consensus long and it's got a lot of enthused investors in it right now. But if you have a price target of $80 on the stock, that probably should suggest that you wouldn't want to own the stock right now. It should be a sell. So I don't really like his take on this. I think if you come out with a price target that's dramatically less than the stock currently trades, that is at the very least a sell rating. Doesn't mean that you need to short the stock. I think shorting is a whole different thing than selling. But you can't sit there and say your price target is $80, but don't sell the stock at $277. That makes no sense.
Around 70% of the CIOs out there say there's no way they would buy something like Tesla. You know, the guys that are long Tesla are momentum players, right? They behave a lot like retail in the way they trade things, but they move much faster and have much higher quality information. And many of them don't fundamentally disagree with me at all.
Well, fundamentally, the stock is overvalued, but you can't play it right now because there's just a lot of momentum in it. Once the momentum runs out, the stock will probably come back to its intrinsic value. Now we move on from that to someone that's bullish on Tesla that believes the company's worth intrinsically more than it trades today.
I think, look, this is a market cap raid. Right? There's massive automation, fully integrated supply chain, optimization of government subsidies. There's no other car company that can beat them at this game right now in terms of scale, other than BYD in terms of in China. And so they're taking market share and market cap from all the other players. And so the goal is to get as many vehicles on the road as you can to get their AI out there, get their mapping out there, and ultimately get to self-driving. The end game is not to be just an EV maker. It's multiple business lines that people are betting on, from insurance to self-driving to energy generation and distribution. So cars are just part one. And if I was Craig and I'm looking just at the car side, I'd agree with him. But all the other things on the other end of that raid makes a big difference. And with a $9,500 profit margin to play with versus GM at $2,100 versus Hyundai at $1,000 or Ford at negative $760 per vehicle, they're taking market share and they're taking market cap.
Now, I have to admit, based on this TV appearance, the first guy got completely smoked. He just got clobbered. The bull on Tesla had so much more information. He had so much more to share. He laid out a stronger case. He did it with more enthusiasm. He actually had more logic behind it, stressing the ecosystem of Tesla that they're building out, how they're much more than a car company. He just did a much better job with this appearance. But overall, I wanted to highlight this to illustrate how much disagreement there can really be on a single stock and even a massive one like Tesla. The idea that the consensus value of a stock is totally efficient and that everything's being priced with total efficiency is nonsense. These stocks trade around 50, 100, 200% in less than a year, in only 6 months, because there's such widely disagreement on the data. And both of these investors, both of these analysts have access to the exact same data. They're looking at the exact same numbers, but they still have massive disagreements on them. So if this isn't evidence that the market is inefficient, I don't know what would be. Now, in the last bit of news, we move to the media world. We have the streaming wars still going on. In my personal opinion, I think that one company has emerged as a pretty clear winner, but we're getting more and more indications of this. We have some news that I consider to be more meaningful than just the headline. We have Insecure, a show that's an HBO original that's now streaming on Netflix. That is a title there that you don't read that often. In fact, HBO is incredibly reluctant and has almost no history of allowing their originals to stream on completely different platforms outside of HBO. Sure, they'll embed HBO's service into things like Amazon Prime as an add-on, But to allow their shows to be licensed to other networks, to other streaming rivals like Netflix, this is something that's literally never happened before. They note that this is actually unprecedented. It was first reported in June 20th that Warner Bros. Discovery was in talks to license some of their original shows to Netflix. In addition, the streamer has confirmed that Band of Brothers, which is a fantastic series, that one is going to Netflix. And that's going to be, I think it's going to be a massive success on Netflix. Then we have The Pacific, 6 Feet Under, and Ballers. These are all HBO originals that are coming to Netflix for the first time ever. Now, this news has caused a lot of buzz, a lot of discussion amongst media analysts and investors in these companies. What does it mean to have HBO shows streaming on Netflix? Well, the first thing that I'll highlight is when looking at Warner Bros. Discovery, this really can't come as much of a shock, especially for a company that's struggling with certain portions of their profitability. So they need to make more money. And this has forced them in a corner where they're trying to make money any way possible. And if that means licensing to Netflix, that's something they're willing to do. And I personally believe this is a huge mistake for HBO. I think it's a big mistake for Warner Bros. Discovery to do this. They're right now placing current cash flows over the future of their company. When they give Netflix some of their best IP, HBO originals are amongst the best IP that Warner Bros. Discovery owns. This trains Netflix users to believe that their streaming service continues to be the foundational streaming service. Amongst all the optional ones, Netflix is the must-have. Now that you have HBO shows going onto it, it further ingrains that into customers' minds. This news also reminds me of how big of a mistake it was for NBC to allow their key series like Parks and Rec and The Office to stream on Netflix. They thought it was a way to make some quick cash, which it was, but what they were really doing was building up their biggest competitor. And in the long run, it cost them big. That's all for this episode. Hope you enjoyed, and I'll see you in the next one.